Hello, future homeowners. Here we are in part 4 of your home buying journey with me, Daniel Byard, Team Ringgold, Keller Williams One Legacy Partner. Today, we are going over navigating mortgage options. Most people know that there are multiple options for a loan. Some might not. There's a conventional loan. There's a VA loan. There's an FHA loan, USDA loans, portfolio loans. Many of these things will change based on who you're borrowing the money from, but many of them will all be the same. What we want to talk about today is the key points of each. We're going to start out with conventional loans. These are the most common loan type that are given to most people. These can be either 3, 5, 10, or 20% down loans where you put a certain percentage of the money down and the bank then agrees to loan you the money. No other major stipulation. Next, we have FHA loans. These loans come from Freddie Mac and Fannie Mae and are backed with extra securities that often allow many more borrowers to borrow at much lower rates, such as those 3 and 5% rates we talked about a moment ago. Next, we have VA loans. These loans are offered to members of the U.S. military who have served a certain period of time of active service and have qualified generally with a honorable discharge from their military service, often while they're still in service. Next, we have USDA loans. These loans are loans that are for rural development areas. Speak with your lender in specific requirements for these because they do often have many specific requirements that are lender to lender and area to area. You may find that one street would qualify for one, but the next street down doesn't. And it's something that you're going to need to look into specifically. I recommend talking to both your lender and your agent for clarification. Next, we're going to talk about types. There's a fixed loan versus an adjustable rate loan. Fixed loans, most of which we've already covered, all have the same interest rate from beginning to end, where an adjustable rate mortgage may vary based on a certain period of time from the point in which you started, sometimes 3 or even 5 years. Next, we're going to cover the loan terms. Most loans that are given under the conventional FHA and VA and many USDA loans and many other types of loans like portfolio loans can be primarily 30-year loans. Some are 15-year loans, others are 20. There are even a few 5 or 10-year loans out there. These durations all play a major factor into what your monthly payment will be. How else can you affect your monthly payment? Well, down payment, which is our next topic. Down payment, which is the amount of money you pay up front. That 3, 5, 10, or 20% is the down payment amount. If you're putting an offer down on a $100,000 home and a 3% loan, your down payment would be $3,000. If you're putting a 20% offer in on a $100,000 home, that would be $20,000, just for simple math. That amount deducts from the total amount that you're borrowing. So instead of borrowing $100,000, if you put down 20%, you're only borrowing $80,000, which moves us to our next point, interest rate. The interest rate is the amount that you pay monthly on top of your monthly mortgage payment that allows the bank to loan you that money. It's how the bank makes their money in this process. If you got a 5% interest rate on that $80,000 loan, 5% monthly is only on the $80,000. I know that sounded confusing, and I apologize. To simplify, you're only paying interest on what you borrowed, not what you offered on the home. As confusing as all of that can be, I want to point out that your lender and your agent are more than happy to walk you through the math on each offer that you make and the loan type, interest rate, and down payments for each. Well, again, this is Daniel Byard with Team Ringgold, Keller Williams. And until we see you guys next time on researching the current market trends, this is your journey.